Let's be honest, if you're looking at the markets right now, things feel, well, pretty nervous. Stocks, crypto, it all seems like it's on edge. But what if all this fear is just a smokescreen? According to Cathie Wood and her team at ARK Invest, we might be looking at a temporary storm, just before a huge economic boom. So let's dive into their thinking and see why today's anxiety might actually be masking a much, much brighter future.
Okay, so let's get right to it. The question on everyone's mind: why is there so much fear out there? You can just feel it, right? It's this anxiety that you can't really escape if you're paying any attention to finance. Well, ARK thinks they've got the answer, and it's probably not what you're thinking.
And this quote from Cathie Wood really gets to the heart of their whole argument. She's basically saying, hey, we see the problem, we get it, but don't worry, it has an expiration date. The idea here is that the mess we're in right now isn't some fundamental breakdown of the system. Nope, it's because of a couple of clear, identifiable, and, most importantly, short-term issues.
So what is that diagnosis exactly? Well, it all boils down to one thing: a temporary cash crunch in the system. We're not talking about a deep, dark recession here, but what they're calling a short-term liquidity squeeze. Let's break down what's actually causing it.
According to ARK, there are two main culprits sucking the cash out of the markets right now. First up, the Fed. They didn't stop their policy of quantitative tightening. That's when they're basically pulling money out of the system when a lot of people expected them to. And second, thanks to the whole government shutdown situation, the U.S. Treasury is just sitting on a giant pile of cash instead of letting it flow back into the economy.
And let's be super clear, we are not talking about chump change here. The Treasury's main checking account is currently holding a whopping $940 billion. That's almost $1 trillion of capital that is just sitting on the sidelines, not circulating in the markets, or it could be doing something.
But, a big number like that doesn't mean much without some context. And this is where it gets really interesting. Normally, that account holds around $600 billion. The fact that it's up at $940 billion means the government is effectively keeping an extra $340 billion out of the financial system. Just imagine what happens when that cash starts flowing again. It's going to be a major boost of liquidity. Okay, but this short-term cash crunch, that's only half the story. ARK is arguing that there's a much bigger, kind of hidden force at play that the Federal Reserve might be missing completely. And this, right here, is where the whole narrative takes a sharp turn. You see, the Fed and all the central banks are still totally laser-focused on fighting inflation. But Cathie Wood believes they're missing some really powerful signals that deflation, prices going down, is the real story. And if she's right, it means our current tight money policies might be a massive overreaction to a problem that's already fading away.
So how do they back this up? Well, they pull out this really fascinating kind of obscure historical indicator. It's the ratio of the gold market cap to M2, which is just a fancy way of saying a broad measure of the money supply. Now, this isn't something you hear about on the news every day, but its track record, wow, it's pretty fascinating. And this is the kicker. Check this out. This ratio has only peaked at the level it's at today twice before. The first time? The early 1930s, right before a huge stock market recovery during the Great Depression. The second time? The early 1980s, which kicked off a massive multi-decade bull run for both stocks and bonds. So with the ratio hitting that same peak again today, history suggests we could be standing on the verge of another major boom.
All right, so if those are the short-term forces and the historical setup, what's the actual long-term catalyst for this boom they're talking about? ARK believes there's this huge structural change happening that almost nobody is pricing in, a radical shift in U.S. tax policy. The key idea here is something called accelerated depreciation. Now, that sounds complicated, but it's actually pretty simple. It's a tax break that lets companies write off the entire cost of a big investment, like a new factory or a bunch of computers, immediately, in the very first year. Normally, they'd have to spread that out over decades. This creates a massive, massive incentive for companies to build and invest right now. And this new policy isn't just some small tweak. In Cathie Wood's own words, it's something never before seen. It allows for 100% first-year write-offs on things like manufacturing plants, equipment, all domestic R&D, and even software. This is a powerful, innovation-first policy that's designed to just supercharge investment here in the U.S. So, what's the bottom line? What does all this mean for businesses? Well, get this. Because of these new depreciation rules, the effective corporate tax rate here in the United States is dropping to just 10%.
Now, to be clear, that's not the official rate you see on paper, but it's what companies will actually pay after taking all these deductions. And on the world stage, that is an incredibly competitive number. And just to put that into perspective, think about this. For decades, Ireland has been famous for its super low corporate tax rate of 12.5%. It's what attracted tons of foreign investment. While the new U.S. effective rate is now lower than Ireland's, this is basically sending a giant signal to the world saying, hey, bring your capital, bring your innovation, bring it back to America. So, okay, let's put all of the pieces together. You've got the end of the liquidity squeeze coming, you've got these overlooked deflationary forces, and you have this massive pro-investment policy shift. When you combine all of that, the whole outlook starts to change dramatically, from talk of a rolling recession to a full-on productivity-driven boom. And what's going to be the engine of that boom? Well, it's the perfect storm. It's the combination of all these new investment incentives with world-changing technologies like artificial intelligence. This mix is just poised to unleash a tidal wave of productivity growth that could literally reshape our entire economy. Which leaves us with this one big final thought. All the fear in the market right now, it's focused on this temporary cash crunch. But just beneath the surface, the foundations are being laid for a massive productivity boom. So as that short-term liquidity comes flooding back into the system, the real question is the market even remotely prepared for what comes next?